April is the favorite month for many Americans because this is the month we get to file income taxes. But did you know when you're doing estate planning, there's 5 other types of taxes that are involved? That's right. We also think about estate taxes, capital gains taxes, California property taxes, gift taxes, and GST taxes. What are all of those, you might ask? So I'm doing a series of 4 videos on 4 different types of taxes that we encounter when we're doing estate planning. In fact, it shocks me that people want to do their own estate plan when they may not understand all of these taxes. Today's video is all about the first one, estate taxes. So you might be wondering, what are estate taxes? Well, this is basically a tax on the estate of a deceased person after they die and before their money is distributed to their beneficiaries. That's the estate tax. Sometimes this is also called a death tax, though I think that term is misleading because that kind of implies that a lot of people or everybody is taxed upon their death, where really the estate tax only applies to fairly wealthy people, and I'll explain why. Okay, so if you have money that is subject to estate taxes, it's a flat tax. It's 40%, which seems like a lot, right? So we want to avoid estate taxes. However, most of you won't be subject to estate taxes. Why not? Because this year, the estate tax exemption is $12.92 million per person. Okay, that's in 2023. So that means if you die and you have less than that amount, $12.92 million, you're not going to be paying any estate taxes. If you're a couple and you both die, and boy, don't make me do math, but that's about 25 million, no estate taxes. In fact, you might be curious to know that in 2020, only 4,000 families or households were subject to estate taxes. That means that only 0.1% of all people in the US paid estate taxes in 2020. A very low amount. Now, if you do have a taxable estate, if you die and you have more than that that's taxable, and we'll explain what is taxable, then you're required to file what we call a Form 706, which is an estate tax return. You have to file that 9 months after the date of death. So this is typically the successor trustee or the executor who's filing this form for the deceased person's estate. But you also get a 6-month extension. So really it's more like 15 months as long as you file that extension. So what about state estate taxes? Well, a lot of states used to have an estate tax of their own, all right? In California, we don't have a state estate tax anymore. There's only the federal estate tax. But there are some states where they do impose a state estate tax. So if you're living in a different state and you die, then you might also be subject to state estate taxes. For example, in Washington state, I believe any assets over $2 million, I think that's the number, are subject to estate taxes. So it's funny, we have a saying here that on the West Coast, you should be born and live in Washington state because they don't have any income taxes. And you should buy your stuff in Oregon because they don't have any sales taxes. And then you should die in California because we have no state estate taxes. Well, what about inheritance tax? So it's typically the estate that's paying the tax. But what about if you inherit money? Are you paying taxes? Well, not in California and not in most states. There are a few states that have what we call an inheritance tax, but in most states, it's the estate that pays the taxes, and then anything you receive is after taxes have already been dealt with. All right, so I'd like to give you a little history lesson about estate taxes, because I think this is kind of interesting, although I am kind of a nerd in this field. Okay, so here is a chart that shows what the estate taxes were since 1997. All right, so you'll see way back when the estate tax was very high. It was at 55%, and you could only protect up to $600,000 before you were taxed. So everybody was very concerned about the estate tax, all right? But then it slowly went up, and in 2002, under George W. Bush, there was a 10-year period where the estate tax exemption gradually went up, all right? It went up and up and up until 2010, when it was kind of like a cliff, it was scheduled to go back down to $1 million. And that year, actually, there was no estate taxes, although things with capital gains taxes changed, and we can talk about that later. So we were all very scared, all right? And then there was a 2-year extension. And then in 2012, a lot of people were giving away their stuff because they were really afraid that the estate tax exemption was going to plummet back down to $1 million and they wouldn't have a chance to give away or die with things. And I remember that because I actually was on maternity leave with my older son. And so happily for me, I missed a lot of that chaos, all right? But Congress fixed it. So in 2013, they established the estate tax permanently at $5 million indexed for inflation. I'm sorry, the estate tax exemption, all right? And so it's been going up, up, up. And then in 2017, under Trump, they doubled it, okay? So, and it's still indexed for inflation. So now, as you can see, in 2018, it was set at 11.18 million, right? So that had doubled the year before, going up, up, up. But then in 2026, the estate tax exemption is scheduled to sunset, and it drops back down to half where it would have been if Trump hadn't doubled it for that 10-year period. By the way, corporations got a complete, permanent exemption, but people only got an exemption for 10 years. So in 2026, we're going to see a drop unless Congress takes other steps to change that. Okay, so how can you protect your estate from estate taxes? Well, I'd like to go back to a diagram that I reviewed in this video called, Should I Simplify My Trust? All right, so we're talking about revocable trusts that might split at the first death. So I want to show you that diagram again. So you'll see in this diagram, at the first death, everything splits into 2 or even 3 trusts. Now, the bypass trust gets the deceased person's estate tax exemption up to the exemption amount for that year. All right, so this year, $12.92 million. So if somebody had a huge $25 million estate, $12.92 million would go into the bypass trust, and just about the rest would go into the survivor's trust. And any overage from the deceased person's half would go into the Q-tip trust. Now the bypass trust, that can grow and grow and grow during the survivor's life. And then upon the survivor's death, it goes to the kids free of estate taxes. All right, so the bypass trust is actually an important trust if you have a larger estate to protect at least that half or the estate tax exemption to make sure that as much can go to the kids free of estate taxes as possible. Now, I've also done a video on dynasty trusts, and these are great estate tax protection vehicles. So the idea is money goes from you to your children into this dynasty trust, and then just like the bypass trust, that money can grow and grow and grow, and on the child's death, when the money goes to your grandchildren, it's free of estate taxes. All right, so that's another great estate tax planning tool. Now, there's an entire field on high net worth estate tax planning, all right? And most of that involves like giving away something for a lower value than the IRS might consider it. So for example, if I give away like 10% of my house to somebody, that gift of 10% that isn't really considered a gift of a fair market value of 10% because who wants to buy 10% of my house, right? You can't really do much with 10% of a house. So the IRS might consider that a gift of 5% of the house, or the fair market value of 5%. So that's one example, but I don't really do that type of planning. I just want to let you know that it's available out there. So if you do have a taxable estate, or if when we're approaching 2026, it looks like your estate might be taxable, it's very important to go to somebody who specializes in high net worth planning to find out what your options might be. Another option for estate tax planning is to make gifts and bequests to charities, because gifts to charities are free from estate tax. You get an estate tax deduction. So it's really great. I've actually had some clients say, all right, I want the maximum amount of the estate tax exemption to go to my children. And then anything over that goes to specific charities or perhaps a donor advised fund. And that can be a very useful way to make sure that money is going to the people and the charities that you want, and perhaps not to the government. Now, one thing I want to mention is that estate taxes and gift taxes are linked. Nowadays, they're part of the unified tax exemption. So that means if you give away some money during your lifetime, let's say you give away $100,000, that eats away dollar for dollar towards your estate tax exemption, minus the annual exclusion. All right. So don't get two bites at the apple. It's not like you get to give away $12.92 million during your lifetime, and then you get to leave another $12.92 million to your kids upon your death. You only get one time. And because the estate tax and gift tax exemption are linked, I'm going to do a video about gift taxes. So thank you so much for joining us, and I ask you to please go and watch this video on gift taxes, and I'll see you over there.